Not yet.
Oh, you can't see my screen yet.
Yeah, I see a screen now.
Okay, great.
I see it.
Okay, cool, great, thanks.
No, I see it. I see it.
Okay,
I see it.
Cool, that's fine, thanks. So I was saying that we have this variance in the expectation, and because of that, it has made it very, very important that the responsibility of the auditors and that of management is actually clarified. And that is why there has to be an engagement letter before an audit is commenced, basically to make sure that everybody has proper understanding of their responsibilities. Okay, are we together?
Yes.
Okay. We'll look at statutory audits, and basically statutory audit is one that is required by law, and there are several organizations that will be required by law to have these audits. For example, audits of companies listed in the stock exchange market, that is going to be a requirement from the Capital Markets Authority. The Financial Institutions Act, they are regulated by Bank of Uganda. Sorry, the financial institutions are regulated by Bank of Uganda, and the Financial Institutions Act actually requires them to have audit. Insurance companies, they are regulated by IRA, and they have to have audits. Telecommunication companies, they are regulated by UCC, and they have to have their audits done. The retirement benefit schemes like NSSF, they are regulated by Uganda Retirement Benefit Regulatory Authority, UBRA, and they're also required to have audits by law. Government ministries and government parastatals, they are regulated by Public Finance Management Act, okay, and they're supposed to be audited by what? By law. So these are the entities that really have statutory audits. Other people can carry out audits, but there will be like more of like voluntary audits, not really like statutory audits. Statutory means it's required by what? It's required by
law.
By law, yeah. And what they really do are not different from what we have really looked at in terms of the purpose of these audits. Strengthening internal controls, identifying any training gaps to be addressed, making sure that the resources are being used well and that properly safeguarded, and ensuring that auditors interface with shareholders in the general meetings, and then ensuring that compliance of the entity with the laws and regulation. In terms of the regulation, there's many regulations that come into play. We've talked about them. We've talked about like the government. They are regulated by the Public Finance Management Act. Things to do with how auditors are appointed, disqualified from office. That is really a requirement and regulated by the Companies Act of 2012. We have banks, insurance companies, telecoms, being regulated by the respective regulation. So there's quite a number of regulators that are going to be in the space within which these companies do operate. Why do we have to regulate external auditors? One, it's ICPA that regulates external auditors, first of all, just to reconfirm that, as we have moved from paper 12. So the reason as to why these are regulated is we need to make sure that they maintain high quality standards. ICPAU conducts quality reviews on external audit firms. This is to make sure that people are doing proper audits and they are doing them in the right manner. And then, of course, making sure that the reputation of registered auditors with the public is maintained. And application of the regulations is also fair, and then the regulations are clear, and then making sure the regulations apply to all auditors. Okay. So that is why the ICPA is going to come in and they issue regulations to the external auditors. Why they regulate them? They need to make sure that public interests are protected, dignity of the profession, reduce the risk, in this case audit risk, and increase public confidence and bring uniformity in the audit profession. At least we all, for example, know that there's an audit manual from the ICPA. Of course, it's going to be in line with the ISAs and all the other international regulations, but that is going to help that to make sure that things are done consistently across all audit firms in the country. And of course, not forgetting that enhancing the quality of the work that is being performed by auditors in the country. Auditor qualification, you can look at that really in your free time, not a lot. There's some things in the Companies Act that we need to look at. Section 167 basically talks about it really talks about making excuse me. It talks about appointments of external auditors and how they stay in office. And section 168 is going to talk about the remuneration of external auditors, how that is determined, and the do's and don'ts when coming up with the remuneration that we make for external auditors. When it comes to limitations, there are limitations of statutory audits. They take, little value is added because of using historical information. Most of the times audits are done after year end. If a fraud happened, it has happened. We can only correct going forward, but we can't really go back to correct what was already lost. And then they might be expensive in terms of the organization. I'm sure you have seen some companies that really don't do audits on an annual basis because they feel they won't get much value, and they just bring a cost to the operation of their business. And then,
but that can't be those ones required by the statutory audit.
sorry?
It can't be those ones required by the statutory audits about the regulations.
No, even yeah, okay. For some organizations, it's really statutory, okay. And it might not profit them a lot, it might not benefit them a lot, but because it's a legal requirement, they will do what? They will do it, okay? And that is why, under those that are not mandated to carry out these audits by law, they choose not to do them because they feel they won't get anything, and they're just going to bring an expense to their operations. And then we know that some companies just do these audits for compliance, and they are not interested in in the reports produced by auditors. But normally these are really companies are not in the regulated space, because in the regulated space, there is a reason why these are legally required, because they are more serious than these other random companies. Let's look at the non-statutory audit. Non-statutory audit is review and verification of the company's business that is not required by law or regulatory agency. Here there is no law, but people just do it to make sure that it's like a housekeeping exercise. So why do they choose to be audited? They might need more working capital, and its investors or lenders are more likely to demand for an audit as a precondition for financing. I have seen some companies that really don't do audits, but because they want a bank loan, the bank says, you go and bring your audited accounts, and they start fidgeting with these accounts. Then the tax authority is also more comfortable if the company has used audited accounts. That's why it is in the law. And if you have revenue exceeding 500 million, you have to file your returns using what? Audited accounts. okay? Because they are more credible and they are more reliable. Some companies might want to get listed like in future, and therefore, you know, from your financial management, that if you want to go and raise money from the public before you get listed on the capital, on the stock market, you must have audited accounts for at least the last 5 years or the last 3 years. So the earlier you do it, the better. Then it's also a health check for some companies so that they can advise through management letters and other compliance requirements. So some people do it just to make sure that they get recommendations from these auditors that can actually help them to do what? To improve. And then some companies may have one shareholders, and because of having different shareholders, they want an independent opinion on these what? On these financial statements. So
but I think for the health check, I think it's for major those big companies, isn't it? Like this, not is it not 4, 5? This all this act as a health check for companies. I think it's major for the big ones, like the Mukwano and what.
Why do you think it's only for the big companies?
Okay, for small companies, the cost might exceed the benefit.
Wow, that's really very subjective still, because
Yes.
because when you say that it's for the big companies, it might not really like be the case, because what is big really is going to vary, okay? Because we have some medium-sized companies that really also want to see how they are doing, and they improve their operations by having what? By having an audit, okay? So it really depends. There are even big companies which we think are big, but you find they really don't value these audit reports. So it might be relative from one company to another, and you know what the corporate governance structure really looks like. And that is why the URA is not going to just sit down and say, let's wait for people to do what they want. They also come in and say, hey, if you're above 500 million, we consider you as big. So file your returns using audited accounts. So, I mean, that's why someone might say it's really very subjective. So who is big and who is not big can vary from one person to another. But yeah, some businesses which might be really like very small, those that are owner managed, where the owner is part of the management team, those might even never need an audit, because if I'm the owner and I'm the managing director and I'm running this business, then I can't be cheating myself. I can't be defrauding myself, if you get what I mean. I can't be misreporting to myself, since I'm the owner and the one running the business at the same time. Yeah.
Maybe the small ones need the consultation or advisory part of the audit firms need that to grow, but auditing.
But then, of course, the other thing is that whereas for the big organizations, you might need, say, full-time internal audit. For the small organizations, you could just have like internal audit come and do like once in 2 years. Others can even do like quarterly. Others can do like once every year. So like you leverage, depending on the level of activity, then you put in as much as you need, not putting in a lot for nothing. You can't say I'm going to have a fully fledged internal audit department and my turnover is 5 billion. It doesn't make sense. Yeah. Okay.
Okay.
Nature, purpose, and scope of assurance engagements. Let's just take a look at what assurance engagements. Okay, excuse me. All engagements performed by a practitioner are assurance engagements. Engagements which are outside the scope of assurance engagements will include related services performed by auditors. We have some services which are performed by auditors, but they are not really assurance services. Say agreed upon procedures. Agreed upon procedures, you sit down and agree with the person. I want you to do for me A, B, C, and D. Okay. Yuka, maybe you know, is a Victor, you are an auditor. I want you to review this, review this, review this, review this, review this, and report to me what you have found out. That's not an assurance engagement. It's an agreed upon procedures engagement. We have compilation of financial statements. If you hire me to come and do for you financial statements, I have not audited them. I have not reviewed them. I will use your TB and your other financial information, and I prepare for you financial statements and I give them to you. I cannot give an opinion if I have not audited or reviewed them. If I prepare for your tax returns, I don't issue an opinion. I just get your information, put in the return, and I submit to the what? The URA. And there are, of course, other consulting and advisory engagements. For example, management and tax consulting. You could ask, you could want a tax opinion, which I can do and submit you with. I can advise you on some of the business things. There could be investment advice and all that. So those consulting kind of engagements are not assurance engagements, and they shouldn't be confused with assurance engagements. So let's look at what assurance engagements really look like. With assurance engagements, there's going to be a three-party relationship where we have a practitioner, we have a responsible party, and we have the intended users. In the example that we have been using from before, a practitioner is the accountant or the auditor. Responsible party is management or the directors, and the intended users are the shareholders. Remember, the intended users are the ones getting the final reports. The responsible party, which is management, prepare the financial statements for the intended users, and the practitioner expresses an opinion to enhance the confidence and the credibility of these financial statements. And there has to be an appropriate subject matter. What is it you're looking at? There has to be something that is measurable. Then suitable criteria, what are we using to measure? If we're talking about financial statements, we have the IFRS, we have the IAS, and then we have the international standards on what? Auditing. That's the criteria that we are going to be using. Then you have to get sufficient, appropriate evidence. And then once you get the evidence, you can be able to write a written assurance report. That is when we can say that there is an assurance engagement. That clearly explains that if someone does your tax return, they will just prepare it and furnish it to the URA. They will not have done what? They will not have prepared any report that they are going to do what? That they are going to submit you, that they are going to give you in any way. So that can basically tell you what an assurance engagement is and how different it is when you compare with other kind of consulting engagements that could be performed by external auditors or accountants, but they are not necessarily assurance engagements.
What? Of course, what I've seen for assurance engagements, there's an opinion you should give, or a conclusion. I don't give a conclusion or an opinion. Isn't it?
Yeah, true. That's very true. That's right.
Also, for other things, these ones sometimes there are no roles specified. For example, the first ones, those ones, these engagements which are non-assurance. Now, in this case, the auditor can perform, they can do accounting, can do this, can do tax returns, but in the assurance, he doesn't do those. Those are not part of responsibilities.
Yeah.
For him, is there too. Yeah, true.
Yeah, right. Okay. Let's look at the fundamental principles that an auditor should be complying with. I'm sure you have looked at this, so we'll just run through this very quickly. There are 5 fundamental ethical principles. That's integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Excuse me. Integrity, basically, we should be honest and straightforward when we are carrying out our professional services. An auditor should be honest and straightforward. You cannot tell lies. You cannot be biased. Objectivity, you should not allow bias or conflict of interest when you're making decisions. Because if you allow bias, if you allow undue influence, this is going to override your professional knowledge and judgments when you're making what? Decisions. So whatever opinion you're giving, it should be very objective. If I'm signing off on your financial statements that they are true and fair, your tax computation should be correct. Not you bribing me with 10 million that you say they are true and fair when the tax computation is actually understating the tax what? Liability. Then there you're not being objective, but you're being biased because you have been given some money. So, professional competence and due care. Auditors sell knowledge, so they should have knowledge, they should have skills that is required to make sure that the services they are giving are professional and they are based on the current developments in the practice, current legislation, and the latest techniques. So, then confidentiality, whatever information you get during your professional relationship, you should keep it confidential. Not give this information to any parties without proper and specific approval from the organization. Of course, there are instances where it could be necessary for you to release this information, especially if it is legal or it is professionally right to disclose this information. And of course, professional behavior, it basically refers to making sure that you don't behave in a manner that is going to discredit the image of the profession. You wouldn't want to hear someone say that, hey, I can't believe he's even an accountant, but he's done A, B, C, and D. So that would mean that someone is discrediting the what? The profession. He should
I think professional behavior is also the dressing code, all that stuff.
Yeah.
But now, let me give an example on professional behavior. Okay, I'm just talking. Now, there's this lawyer I've been seeing on TV. What's what?
Yeah.
Yeah, I've been seeing the news. The Victoria University chancellor who was abducted. His lawyer, he had dreads. So don't they have professional behavior and they are thinking code of ethics?
So just say that again.
The lawyer, the lawyer for this vice chancellor of Victoria University.
Yes.
On TV, he had dreads and had beard and and I don't know that because I thought lawyers will have something like professional behavior, tight professional behaviors, how you wear, how you dress. So are there no implications in case I just put on my t-shirt and I go to a CPA firm, for example?
I just want to just confirm that I got your question correctly. Oh, your comment.
No, it's not a question.
Like it's
just a comment.
It's a comment, yeah. But every people are like at least for the professional accountants, I know we have the the code of ethics, and then we have the what people should be doing, like what is expected of them. For the legal fraternity, I won't say much, but I'm sure there is, because they are also they also have a body that looks after their what they do. They have the licensing and all that. But I have had quite a number of times some people comment that lawyers are are not straight. So
not straight at all.
So I have also noted it in instances where I've dealt with them. So but I think their space is not really very so much grounded on the ethical requirements. So that is how we end up having some of the statements like lawyers are shrewd, or they're not very professional people, or they like shortcuts, or they can make anything happen. So things like those. Okay, concept of accountability, stewardship, and agency. I think we've talked about stewardship and agency, so you don't need to talk about that a lot. We just find some time and go through this. Reporting as a means of communicating different stakeholders. We've talked about this. Reasons and mechanisms for the audits of accounts of sole proprietorship and partnerships. Now, sole proprietorships, these are small businesses you've been talking about. Okay. They might also want to benefit from some of the outcomes of these audit processes. Okay. Even though they are ever present in these businesses, and maybe they are not mandated to be audited, but they could also do what? Benefit, okay? So when you're carrying out audits of some of these small entities, you should really carry them out with considerations of the what? As the large entities. We know they are very small. Some of the things will not really apply, like the standards and all that, but you still have to make sure that you think through their businesses and apply the best practices from some of these large organizations. Just give me 1 second.
It's okay.
Okay, so there could be difference on how this audit is done. Things like the audit strategy, you might have to do a lot of substantive testing, because these are companies that do not have a lot of controls and systems and processes, and therefore you might have to do a lot of what? Do a lot of substantive testing, or test of details, not controls testing and analytical procedures. In terms of documentation, they might not really have a lot of evidence as these big companies. These big companies might really have a lot of systems, procurement processes, where you order, LPO and everything, but a small business, it could just be the managing director passing via a shop, and they buy some of the items they need in the business, so they come with them in their bag. Maybe no invoice, no nothing. So the kind of documentation might actually be very relaxed compared to these big operations. Then ethical requirements. Small entities normally don't have a lot of independence issues. For example, when you're doing a public listed company, the independence requirements or checks are really very detailed, because you don't know who owns what in this company, you don't know what connection and all that. But a small business, one shareholder, if it is one shareholder, there's no possibility that there's a lot of independence threats from an auditor's perspective. And then, of course, things to do with internal controls, representation from management. There could be those limitations, but you've got to do what? You've got to, deal with them in perspective that this is actually a small entity, not a very big entity. So, do you have any questions there?
No question.
Great. Fair presentation of financial statements. This is really financial reporting topic, and I'm sure you have looked at that exhaustively. What is made up of a full set of financial statements that comply with IFRS? We have a statement of financial position. We have the statement of comprehensive income, or the statement of profit or loss, the equity statement, cash flows, and then notes to the financial statements. Fair presentation will, you've taken a look at this from a financial reporting, so we really don't have to like spend a lot of time there. Of course, the accounting policies need to be applied accordingly. Then they need to ensure that information is relevant, reliable, comparable, and understandable. Those are really the fundamental principles of financial information. Sorry, the fundamental characteristics of financial information in making sure that it's relevant, reliable, comparable, and understandable. And of course, making sure that you provide additional disclosures that will help people to understand these financial statements and ensure that they are complying with the specific requirements in the what? In the IFRSs. So let's look at audit objective and how do we obtain audit evidence and how do we form opinion. So the objective, in accordance with ISA 200, International Standards on Auditing 200, there are two. One, obtain reasonable assurance that the financial statements are free from material misstatements, whether due to fraud or error. Okay, and then you will be able to express an opinion as to these financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. And then you've got to report on the financial statements and communicate as required by the ISAs in accordance with the auditor's findings. So there is two: get evidence about the truth and fairness of the financial statement, and then you report based on the what? Based on the evidence that you have gotten. The objectives of the auditor are the assertions of the auditor. In whatever you're doing, assertion, truth and fairness, you're looking at these things. About classes of transactions, when you talk about classes of transactions, we are talking about profit or loss. You're making sure that the transactions occurred. You're making sure that the transactions are complete. You're making sure that the transactions are accurate. You're making sure that the transactions are recorded in the right accounting period, that is cutoff, and you're checking to make sure that the transactions are properly classified. Okay, we do not have rent in cost of sales. We do not have cost of sales in revenue. We do not have cost of sales in operating expenses. That is classification. We do not have staff costs and repairs and maintenance. Sawa.
So
those are the objectives that you are moving with when you're carrying out or when you're running into this audit. Okay. When it comes to account balances at the end of the period, that is the balance sheet. Okay, or assets and liabilities. We have existence. These assets are there. If it is PPE, we can go and find these assets. If they are liabilities, they are there. If it is equity, that equity interest exists. The shareholders have put in money into the business. Rights and obligations, it means that the entity is responsible. If they are assets, it has rights over the assets. Rights from the financial reporting framework of 2010, we define an asset as a resource controlled by the what? By the entity, arising from past events. Okay. from which future economic benefits are expected to flow into. So that means that you should be having rights over this what? Over this asset. If it is a liability, you have an obligation to pay. We have a definition for liabilities as present obligations arising from past events, settlement of which will lead to outflow of economic resources. Will lead to outflow of resources embodying economic benefits. Okay, so I mean, that is it. You have to have the rights over these assets. You have to have obligations with respect to these liabilities. Then you have completeness, making sure that all assets, all liabilities have been recorded, like there's nothing missing. Valuation and allocation, in some cases, we can refer to it as accurate. The assets and liabilities have been recorded at the right amounts. If it is stock, it has been valued properly at the lower of cost and net realizable value as required by IS 2. If it is assets, they have been valued properly in accordance with IS 16, which says that assets should be recorded at cost, let their accumulated depreciation and any impairment losses. If it is receivables, they have been properly valued in accordance with IFRS 9, measurement of impairment with respect to what? To financial assets. So, we have assertions about presentation and disclosure, pretty much like what we've looked at already, occurrency and rights and obligations. Whatever presentation you're making, whatever disclosures you're making, they occurred, or maybe we have events, we are disclosing events that have occurred or that we have rights and obligations over. And then completeness, the disclosures should be, like those other disclosure requirements that we make in financial reports. Every accounting standard has disclosure requirements.
Yes.
Those
yes.
disclosure requirements should be accurate, should be complete, should be properly classified, and like everything. You should not just make disclosures which are not accurate. Otherwise, you're going to have to mislead what the users of the financial statements. So, audit evidence. This is the information that is used by the auditor in arriving at the conclusions on which his opinion is based. Audit evidence is going to include both information contained in the accounting records and other information or other support documents. So basically, this is like what you base on to form an opinion on these financial statements. How do you obtain this audit evidence? Let's look at this very quickly. You can inspect. You know what inspection is?
Yes. For example, inspection of documents, inspection of, in case it's an inspection of machinery, to make sure the evaluation is right and such stuff. Inspection of such stuff. Once going to the place itself to inspect the segregation of duties. That is.
Yeah. So that's you can inspect companies' documents, invoices, records, systems, even physical inspection, to make sure that you get the evidence that you want as basis for forming your opinion. Observation, there's evidence that can be gotten by observation. For example, if you want to confirm that stock exists, you have to go and observe that it was there at the end of the what? The end of the. You can observe like some controls, maybe in cash being paid out. Like there are several processes you can observe to confirm something or to get the evidence about something. External confirmations, this is normally done for like receivables, payables, cash and bank. Yeah, we can confirm with external parties to confirm the balances that the company already has with them. And some of the evidence can be gotten through like recalculation. You could have your assets, you've calculated your depreciation. I could apply the same depreciation rates and recalculate the depreciation and confirm if this is actually correct. It could even be like just like mathematical verification to confirm accuracy by recalculating it. Then we have reperformance. Reperformance is basically doing something to see if you come up with the same conclusion or the same results as the initial person who did it. Okay. A very good example is like when I'm testing controls, say I'm dealing with maybe a bank, I could try to initiate a check and see if the controls that are in the process of initiating a check and getting it paid out actually apply. If I'm going to initiate it, if it is going to require me to approve, then it goes to the second approver, then look at the limits and then get approved, and then I can be able to do what? To effect the payment. You could reperform like some of the recalculation. Okay, so like reperformance and recalculations could actually, like work hand in hand. You can reperform some walkthroughs, okay, and make sure that you see that it is taking you step by step where you expect this to be happening. And then you can also use analytical procedures. Analytical procedures is basically comparing financial and non-financial information.
Also, I think also using ratios.
Yeah, you can use ratios.
Yeah, comparing past and present.
Yeah, you can use
budgets.
Yeah, budgets and actual. You can use trend analysis. You can use forecast information. So that can also help you to get evidence. For example, someone can compare the increase in debtors days and see if it is in line with the debtors balance. Someone can consider a gross profit margin and he sees if this is verifying or confirming the sales that have been recorded in the financial statement. Yeah. Then, of course, inquiries. Audit, you can't fail to inquire. There are some things which may not be in writing, but you just need to
inquire. Ask the manager, ask the finance manager.
Yeah, ask
the staff.
Yeah, like you rely on the inquiries that you have made with management of these organizations. Excuse me. So quality of audit evidence. There are two concepts: quality of audit evidence. Excuse me, just 1 second. So quality of audit evidence basically looks at the reliability of the audit evidence, and there are several factors. Like quality is like how good is the evidence that you're having? Is it reliable? Is it relevant? Like, is it connected with what you are looking for, with what you're trying to verify as an auditor? What are the factors that affect the reliability of this quality of this audit evidence? If it is obtained from independent sources outside the entity, this is really very good evidence. It is reliable and therefore it is of good quality. Very good example is, say, external confirmations from clients or from suppliers or from the banks. It is more reliable than anything else. If it is generated internally, but the rated controls are working very well or effectively, it is good evidence. You trust the evidence that you're getting because the internal controls are effective. Otherwise, if they are not effective, then you can actually have what? You can actually have issues. Some could be fraudulently being presented as evidence, and it's actually not quality evidence. Then if it is directly obtained by you, it is more reliable. For example, if you go and observe the stock counting, you have seen by yourself. You're not being told, you're not being reported to, but you saw by yourself. And therefore, that kind of evidence is of high quality. Then if it is in documentary form, it is more reliable than the evidence which is oral. And then the one that is provided by original documents is more reliable than the one that is gotten from photocopies or documents that have been filmed. So yeah, that's it. There is just a little bit of detail just on the methods of obtaining evidence. So you could just read about it in your free time, but this is what we've already discussed about. Okay. I'll beg that we stop here.
You're tired.
Yes, for today. And, we will pick up from there next week. Yeah.
So you're going to be sending the notes, eh?
Yeah, I'm going to send you the notes just right after this. And then you can read through during your what?
During the week.
During the week, yeah. Okay, thank you very much, and have a very good weekend.
Thank you very much, sir.
Okay.
Good night.
All right, good night.